Hello, everyone. Thank you so much for attending our webinar today on tax tips for 2020 and 2021. My name is Sasha Preston-Sooney, and I work with Chug CPAs LLP in our Los Angeles office. Tax season is a complicated time. Our team of experts is here to help demystify new tax rules and help you save on your business and personal taxes in 2020 and beyond. If at any time during the presentation you have any questions, please feel free to enter them into the Q&A chat box, and we will be able to answer as many questions as time permits at the end of the presentation. Today, we've got a great panel of experts here to share their tax insights with you. We have Khushbu Doshi, CPA and team lead in our Santa Clara, California office, Pooja Srivastava, team lead in our Santa Clara, California office, and Swati Gandham, accountant in our Reston, Virginia office. So let's get started. Swati, what are some important changes that people should be aware of as they get ready to prepare for their 2020 personal taxes?
Thank you, Shasha, for the question. It's very interesting and important topic for the tax year 2020. Let's discuss one by one. First one is standard deductions. It is increased for all tax filing categories in 2020. Let's say, for example, joint filers, it is increased from $24,400 to $24,800. You can either itemize your deductions like mortgage expenses, medical expenses, charitable donations, etc., or you can take the standard deduction. Either way, you decrease your taxable income. Second one is charitable deductions. Individual tax filers can deduct up to 100% of adjusted gross income, up from 60%. Donations more than 100% of AZI can be carried over to future years. Also, people who do not itemize their deductions can write off up to 300 of charitable cash contributions and is limited per return, not per individual in 2020. And then extended tax breaks. Several expired or expiring tax breaks were revived late in 2020, available most through 2020. This includes deductions for mortgage insurance premiums on college tuitions, as well as 2 million exclusion for forgiven mortgage debt and credit for certain energy saving improvements to your home. Thank you, Josha.
Those are some exciting changes. Could you tell us more about tax saving opportunities available for personal taxes in 2020?
There are certain tax savings available for individual tax filers. First, let me explain about earned income tax credit and additional child tax credit. EITC is for low to moderate income families can earn this credit equal to percentage of their earnings up to a maximum credit. Also, it is a dollar for dollar reduction in your actual tax bill as opposed to a tax deduction, which simply reduces how much of your income gets taxed. It is truly fun money because if your credit reduces tax bill to below zero, the IRS might refund some or all of the money to you. Also, it is depending on the credit. Under the new rule, if your 2019 earned income is higher than your 2020 earned income, you can claim a higher credit. This rule also applies to additional child tax credit, which is for certain people who get less than full amount of child tax credit. Most popular deduction is pass-through income for self-employed individuals, owners of LLCs, S-corps, and other pass-through entities can deduct 20% of their qualified business income straight away. For 2020, the limitation for this deduction was increased. This means individuals with higher taxable income can claim the pass-through deductions. Let me explain about retirement accounts. Beginning age to required minimum distributions up from 17.5 to 72 years. Only for the accounts owners who turn 17.5 from 2019. Seniors can skip the 2020 RMDs without penalty under CARES Act. Owners of traditional IRAs can make contributions after the age of 17.5 starting in 2020. For other additional changes, I highly recommend you talk to your CHUK CPAs LLP professionals. Thank you, Shasha. I hope you that got my answers.
Thank you so much for that, Swati. Now, what is some general tax savings advice that individuals should consider for tax years 2020 and 2021?
There are great general tax savings for 2020 and 21. Let's discuss few. First, 401k investments. The IRS doesn't tax what you divert directly from your paycheck into a 401k. For 2020 and then 2021, you can direct up to 19,500 per year into 401k plan. Suppose if you are 50 or older age, you can contribute an extra 6,500 in both the years. Contributions to an IRA. You may be able to deduct contributions to traditional IRA through how much you can deduct depends on whether you or your spouse is covered by the retirement plan at work, or depends how much you make. You have time limit until the tax filing deadline to fund your IRA for the tax year 2020, which gives you extra time to take advantage of this strategy. That is 15th of April 2021. Also, you can save for college by making contributions to 529 plans, a saving plan operated by a state or educational institution. Also note that you can't deduct these contributions on your federal income taxes, but you might be able to get deduction in your state return if you are putting money in state's 529 plan. There may be gift tax consequences if your contributions plus any other gifts to a particular beneficiary exceeding 15K. Let's discuss about a flexible spending account offered by your employer. It is a funnel tax-free dollar directly from your paycheck to your FSA account. In 2020 and then 21, the limit is 2,750. You will have to use this money during the calendar year for the medical and then dental expenses, but you might also be able to use it for any related everyday items for yourself and then qualified dependents as well. Contributions to health savings account. Contributions to health savings accounts are tax deductible and the withdrawals are tax free too. So as long as you use them for qualified medical expenses. For individuals with high deductible healthcare plans. Deduction of medical expenses. It's truly found money. Because if your credit reduces your tax bill below zero, the IRS might refund some or all of the money to you, depending on the credit. Let me explain some self-employed deductions. Vehicle mileage for business use, shipping and advertising expenses, other business expenses if any, but be sure to maintain proper records or you might lose your deductions. Also, you will get deduction for private mortgage insurance premiums. Let me explain last important point while filing taxes. Don't forget state and local tax breaks. While the federal tax reform law eliminated some miscellaneous deductions, many states will allow them or they may have a lower threshold for claiming. For instance, in New Jersey, taxpayers can deduct the cost of medical expenses exceeding 2% of their adjusted gross income. But on federal taxes, only medical expenses more than 7.5% of personal incomes are deductible. Thank you, Shasha.
So with the COVID-19 pandemic, there are many new opportunities for businesses to save on their taxes. Khushbu, could you tell us about the tax refund options available for businesses in 2020?
Thanks, Sasha. I would like to start with the tax refunds. What are tax refunds? A tax refund is a reimbursement to taxpayer of any excess amount paid to the federal government or a state government. Deferred taxes. Usually, you must deposit employment taxes, which is income tax withheld from your paychecks, plus the employer and the employee share of Social Security and Medicare taxes on the on the worker's taxable compensation according to a set schedule. If you don't, you can be penalized. However, under a new rule, you can elect to defer the employer's share of Social Security taxes from March 27, 2020 through the end of the year. If you make the election, then 50% of the deferred amount is payable by the end of 2021 and the other 50% is payable by the end of 2022. However, if you have received a PPP loan, you must stop the deferral once the loan is forgiven. Next item that I would like to discuss is about net operating losses. If you have suffered a net operating loss in 2018 or 2019, you can carry back these losses for a period of 5 years to offset all the taxable income in those years. The result is an immediate tax refund. IRS has provided procedures to expedite these refund claims as well. Interest expense limitation. Business that don't qualify under a small business exemption based on the amount of average annual gross receipts are subject to a special limit on the amount of interest paid that can be deducted. The CARES Act liberalizes the rule to allow for greater deduction, again permitting amended returns that may produce tax refunds. One last big item is the qualified improvement property. If you have made certain improvements to the interior of a commercial space, such as a restaurant or a retail store, you can now treat these costs as fully deductible using bonus depreciation in the year in which you place the property in service. Previously, such costs had to be depreciated over 39 years. Again, the IRS has provided procedures to make this change in accounting method and obtain tax refunds. These are some of the credits and the strategies that are given to us for the business refunds in 2020, Sasha.
Now, tax credits also provide another way for businesses to save big on their 2020 taxes. Khushbu, could you tell us a little bit more about some of these tax credits that are available?
Tax credits are even better than the tax deductions because they are 100% offset against taxes. Typically, tax credit offset income taxes, but new credits offset certain employment taxes as well. Employee retention credit is something that a qualified small business that pays qualified wages up to $10,000 per employee plus health insurance coverage after March 12, 2020 and before January 1, 2021 can take a 50% credit. The credit is refundable, so it can be recouped even if it's more than the taxes owed. A qualified small business is the one where the business is partially or fully suspended because of COVID-19 or has gross receipts of 50% of the comparable quarter in 2019. The credit is an offset to all employment tax deposits and is figured on a quarterly basis, starting with the second quarter of 2020. If the employment taxes are not sufficient to cover the credit, the employer can receive an advance payment from the IRS. There is a new tax form that's available to obtain the advance payment of the employer credits. Another credit that I want to speak about today is about the paid sick leave. Small businesses required by the FFCRA, which is Families First Coronavirus Response Act, to provide certain paid sick leave to employees up to 80 hours can take a fully refundable tax credit to offset the required payments. An advance payment similar to the treatment of the employee retention credit also is available here. Small businesses required by FFCRA to pay up to 10 weeks of family leave related to COVID-19 can also take a fully refundable tax credit. Again, an advance payment similar to the treatment for the employer retention credit applies here. You can't use the employee retention credit for the same wages that have been subject and paid for the leave credits. Over to you, Sasha.
Now, a lot of our attendees today have probably taken out a PP loan or they plan to take out a second draw PPP loan. Now, how should those businesses report their PPP loan forgiveness on their taxes? Khushbu?
This is the most popular question that we have been receiving over the last couple of weeks. And as we work on preparing the tax return, this is what I have to say in this regards. PPP loan proceeds are tax exempt. Your PPP loan is not taxable income. In general, businesses can deduct expenses paid with PPP loan funds. The rule applies to the first and the second draw PPP loans, and it also applies to the EIDL, which is the Economic Injury Disaster Loan grants and advances. However, the treatment of the same has been varying from state to state. As far as California is concerned, the state law prohibits this, but there is a pending legislation and a proposal that California business owners may be allowed to deduct expenses paid with the PPP loan funds. As we await the decision from the California board, we will post more updates as and when we get informed from the state. Thank you.
Thank you for that, Khushbu. What should individuals keep in mind for their taxes if they received unemployment benefits and stimulus payments in 2020, Pooja?
Thank you for your question, Sasha. The unemployment benefits are considered taxable income, as everybody knows, and you would be getting a corresponding 1099-G form if you've paid any taxes, if anything has been withheld in terms of state or federal, it will be mentioned on that. So don't forget to give that to your trusted advisor, your tax consultant. The second thing is the stimulus payments are not considered taxable, but the IRS wants to know how much you have received, whether it was 2020 or 2019. The amount needs to be mentioned. Do not forget to let your tax preparer know that these are the corresponding amounts that you got. I hope that answers your question, Sasha.
Now that we have a new presidential administration, there are some possible changes on the horizon for taxes for individuals and for businesses. Pooja, could you tell us about some of these potential changes?
It is important to note that there are many changes, but they're all pending. It is unclear what tax policy would be passed because of the new policy would require a substantial majority of the votes from the Congress, as everybody knows. Although we do have some updates of what are the potential changes under the Biden recovery plan. Of course, the Silicon people are, especially our clients, would be impacted by the top tax rate. Most of our clients would be. If your income is greater than 400K, you're most likely going to revert back to 39.6% here. Huge planning opportunities would come out of this. Please contact us as the legislature kind of like firms up as we go. Most of the TCJA, that is the Trump tax cuts that were there, would be rolled back as well, including the 21% corporate rate. Also, they are planning to incorporate alternative minimum tax for the corporations. This is a space to watch out for. Again, some place for planning, considering what you want to do over here. Other tax increases are also expected. Social security taxes, capital gains, they're all about to change, and the thresholds are going to be increased as well. The Biden payroll tax proposal would subject wages and self-employment income in excess of $400,000 to Social Security payroll tax. This will go up. Currently, we are at 6.2%. Definitely, we're looking at some more complex and much higher taxation here. For those people who are self-employed individuals who pay both employee and employer halves, the tax is 12.4%. If the law is enacted, business owners might want to consider converting to an S corporation, as the dividends from the S corporation are not subject to employment taxes. Again, some planning opportunities here. As the law firms up, we can definitely help out. For executive compensations, the incentive stock options would likely become more popular. Again, due to the tax benefit of not having the Social Security tax on that, that option spread. So I hope that answers some of your questions, Sasha. Thank you.
So there are also some potential changes on the way for the way that estates, certain inheritances, and retirement funds are handled. Pooja, could you tell us about some of those possible changes?
This is going to be a huge change for people who make a lot of money and who are looking to put out a lot of money to their kids. Again, I would suggest that you watch out for this space. So the 2021 estate tax exemption threshold currently is sitting at 11.7 million per individual, with a top tax rate of 40%. With the TCJA, after 2025, the amount is scheduled to revert to pre-TCJA, which was 5.8 million. Although now, with the Biden plan, we are going to accelerate the reduction for the exemption now, and we are going to go as low as 3.5 million, which was also proposed by Obama, which is a huge spread here that we're looking at. The top tax rate, again, is possibly going to increase by an additional 5%, bringing it up to 45%. The step up in basis would be eliminated completely. Again, that's also waiting on the congressional vote. The Biden plan is also looking at changing the retirement plans and how they work. They are planning to increase the mandatory age from 72 to 75 for the required minimum distribution. This might be happy news for some people. Automatically enroll employees in 401k, 403b, and simple plans, unless employees opt out of these. Again, here we're looking at something called a new credit that they're trying to get for people, trying to encourage people to save a little bit more. Again, we're looking at about 3 to 10% of savings for a lot of people. That's what is the estimation. They're also planning to have a higher catch-up contribution for people 60 and above. So while these changes could go in effect after January of 2021, and we are still looking at the legislation on these, the unemployment is high and the economy is still recovering. It seems more likely expected that the tax increases would be affected for 2021, but these will be only taken care of in the year 2022, January 1st. So we have enough time for the investors to plan, individuals to work this out with their CPAs. Thank you so much, Sasha. I hope it answers some of your questions.
Wonderful. Thank you, Pooja. So that brings us to the end of the presentation portion of our time today. However, we still have some time to answer some of your questions. If you haven't already, please feel free to enter some of your questions into the chat box, and we will be happy to answer as many as we have time for. It looks like we have already received a few questions here. Our first question is for Swati. What are RMDs?
Thank you, Sasha. RMDs are amounts that US tax laws requires one to withdraw annually from traditional RIS and employer-sponsored retirement plans. RMD rules apply to the tax-deferred retirement accounts. When you reach age 72, it was up from 17 and off, as per Secure Act. I hope you that got my answer.
Wonderful. Thank you, Swati. This next question is for whoever would like to take it. So this person is a Canadian permanent resident, but they're working in the USA on an H-1B visa. They're wondering, what should I do to claim taxes this year? Do I need to claim taxes with the IRS or Canada CRA only? Besides, is there anything else I should pay attention to? Thank you.
Thanks, Sasha. First off, thank you for the question, and I would say just connect with us. That's the first thing you need to do, because this is something that we do all the time. If you have earned income here and you have earned income in Canada, we are going to give you some benefit of it. So let's say you have 100,000 of income in Canada. You are going to get some credit for that if you've already paid taxes. So you're not going to be double dipping and paying taxes in both the places. Of course, there's math to that. There are multiple compliance forms to that, and we're always there to help you out. But we want to make sure that we're not going to have any double taxation in both the places. You'll only be paying tax as much as you need to. Thank you.
Thank you, Pooja. This next question is for whoever would like to answer it. This person is wondering, can you help me get the employer retention credit? I am hoping to get more information about that.
So, of course, we can help you to get the employee retention credit. To get more information, please do connect with us. There are different ways of first determining the eligibility, whether you are really eligible to get the credit. Also, we need to analyze what expenses for payroll that you have used, whether or not you have received the PPP loan and other requirements before we can compute the amount, how much of credit that you can be eligible for. So be sure to connect with us and we will help you claim for the credit. Thank you.
Wonderful. Thank you, Khushbu. So this next question is for Pooja. What is a step up in basis?
Thanks, Sasha. That's a good question. We always get asked these questions. We are talking about step up in basis right now because Biden is planning to remove this completely, but I'd like to explain a little bit just through an example. If your parents own a huge amount of properties that they're going to transfer to you, in a normal circumstance, if you inherit it, that is, if you receive that property after your parents have passed away, you will take the value on the date of death and you will sell it then, giving you a very, very small or a nominal gain on your tax return. If this is done away with, and if your parents had that property and there's going to be no step up in basis, that means if your mom had constructed a property in 1970 for $25,000 in San Jose, California, which was very likely, and now it's sitting at $2.5 million, you are looking at the entire gain there. So when people say we're going to do away with step up in basis, that's going to be a huge hit when you get a property. And definitely consult us once that is in place. We can definitely help you out with this. Thank you.
Thank you, Pooja. This next question is for Swati. Are extended tax breaks applicable for previous years?
Thank you, Shasha. It's a good question. Yes, extended tax breaks are applied for 2018 and then 2019 as well. So if you qualified any of the in like those years, it might be worth filing an amended return and claiming a refund. I suggest you to please approach us for like to file an amending return. We will help you in that. Thank you.
Thank you, Swati. This next question is for Khushbu. Are self-employed individuals eligible for the employee retention credit?
Most popular question at the moment. No, self-employed individuals are not eligible to get the retention credit for their own portion of salary. However, if they employ people in their regular trade or business, then for those and they qualify as an eligible employer and meet other requirements of the credit, then they would be eligible to get the credit. Again, not for their own portion, only for the portion for the employees that they hire.
Thank you, Khushbu. Just a reminder, if you haven't already, please submit your questions into the Q&A chat box. We just received another question. This person is wondering, is it beneficial to claim carryback under the CARES Act or carry forward the losses as tax rates are expected to increase?
It will depend on how your previous year returns look like, what kind of income you have reported, and the amount of NOL carryback that we are looking at. Of course, as the tax rates are going up, this is one thing that you would have to, probably reach out to us and we can sit down and look at your projected financials for the next year and decide whether it will be beneficial to go backwards or take it forward.
Thank you, Khushbu. This next question is for Pooja. Should I start planning for 2021 with my estate planner right away?
I would say wait it out a little bit, only because we are moving from 11.7 million to about 3.5 million. Let the legislation kind of firm up what they're trying to do and then get in touch with your attorney, your estate attorney, or whoever it is your trusted advisor is. It will take a little bit of time to kind of firm that up. So hold on and watch out.
Thank you, Pooja. This next question is for Swati. Can I claim both the earned income tax credit and the child tax credit?
Thanks for the question, Sasha. Generally, no, but if you are eligible, you can claim both the credits. The child tax credit is a credit for having dependent children in the age 17. The earned income credit is a credit for certain lower income taxpayers with or without children. We suggest you to contact your CPA for more details. We definitely help you in that.
Thank you, Swati. This next question is for Khushbu. Are tax-exempt employers eligible for the employee retention credit?
Very good question, Sasha. So the tax-exempt employers, which is pretty much the non-profit organizations described under Section 501C, they could be eligible employer for the purposes of employee retention credit, provided they are meeting the requirements of the credit to become an eligible employer. So I believe that will answer your question.
Thank you, Khushbu. This next question is wondering, do you know whether we report PPP loans and grants as income on our taxes?
I can take that. So PPP loans, if they are forgiven, then we would be considering it as a non-taxable income. For whatever purpose, if you are not planning to apply for forgiveness and you are having that loan with you, then that loan will be treated as a liability. So depending on whether or not you applied for forgiveness and depending on how much is the amount, there are different outcomes to the same item. EIDL grants are tax-free income, and even if you report it as income, you have to report it in Schedule M1 in your taxes to make it a non-taxable income. Thank you, Sasha.
Thank you, Khushbu. Okay, this next question here is for Pooja. Do you have someone at the Chug CPAs LLP that can help me with this type of estate and inheritance planning?
Sure, we do have people here, attorneys specifically, who help with the trust, estate planning, etc. So this is always a question for people with the higher incomes, with a lot of inheritance that they're looking at. So please connect with us. We'd be happy to help out and create something nice for you, depending on how the Biden plans kind of firm up. Thank you.
Thank you, Pooja. This next question is for Swati. Can I deduct my 401k contributions on my tax return?
Absolutely. You can deduct 401k contributions. As for IRS guidelines, your employer doesn't include your pre-tax contributions in your taxable income because your 401k contributions are tax deductible. Usually employers, what they do is like they report contributions in box 1 and then 12 of like the form W2. We will help you to figure out and then to file the taxes to take the deductions as well. Thank you.
Thank you, Swati. Now we have some more time left to answer your questions here. So please feel free to enter your questions into the Q&A chat box and we will be happy to answer them. We've got some more time left. This next question is for Khushbu. Can employers claim the employee retention credit if they've already had a PPP loan?
That's a great question. A simple answer is yes. And the reason behind it is if the employer that is eligible to take the employee retention credit can claim ERC, even if they have received the PPP loan. the eligible employer can claim the ERC on the qualified wages that are not counted towards the payroll cost in seeking the forgiveness for the PPP loan. Any wages that have been counted towards the PPP loan, you will not be able to use them for ERC, and pretty much it's called a double dip, which is not allowed. So any portion of payroll, for example, you have $1 million of payroll, of which you use 600,000 to claim for the PPP forgiveness, the balance 400,000 you would be taking as an eligible expense, and then you would qualify as an eligible employer for claiming the retention credit. I hope this answers your question.
Thank you, Khushbu. This next question is for Pooja. How can we get the stimulus check if we have not already gotten it?
So the rebates or the stimulus are based on the 2019 tax returns, and therefore a taxpayer would receive a tax payment through a check or through the bank. If it is less than what you're entitled to receive, or if you have not received anything, you might be able to get an additional credit for this on your 2020 tax return. If you're eligible, please contact your CPA tax preparer who can help you out with this. There is a particular form that needs to be filled out. And once you do that, you're sure to get a nice credit on your tax return for 2020. Thank you.
Thank you, Pooja. We've got another question that just came in here. This person is wondering, have you got any advice on starting a business? Is there any advantage to forming a corporation or an LLC in California? Does the type of business matter, such as a convenience store, trucking, or personal services work?
Of course, we do provide consultations to our clients on determining which is the right type of entity that they would like to set up for their business, depending on their business needs, their long-term plan. We sit with our client, we discuss their goals, and accordingly we decide the state where they need to incorporate, the type of entity they need to incorporate. So of course we can provide a lot of guidance in this sector. Advantages of forming a corporation as compared to an LLC in California. LLC does have LLC fees as well, in addition to the 800 annual tax. So 800 annual tax is a minimum tax, and whether or not you make any profit from the business, this is the amount that you need to pay to the state of California. LLC has, in addition to the $800 LLC fees, which depending on your income could go anywhere from $900 and above. Does the type of business matter? The type of business does not really matter. It could be anything. It has to definitely be a legit business. And as I said, we can, provide you guidance on a one-on-one basis. You can reach out to us, and then we can explore what options you may have to make the best out of what you plan to have and get the optimized tax savings. Thank you, Sasha.
Wonderful. Thank you, Khushbu. So I believe that brings us to the end of our questions today. If you didn't get the chance to ask your questions during our presentation, please feel free to send an email to one of our presenters using their email addresses that you see on the screen, or you can send an email to info@chug.com. Also, feel free to reach out to schedule a consultation. We have live webinars every month that help small businesses weather the pandemic. Please visit our website at www.chug, that's chugh.net, so that you can register for an upcoming webinar. We also recommend subscribing to our YouTube channel, that's Chug LLP, to get great new business content every week. Thank you so much for joining our webinar today, and we wish you a safe and happy week ahead. Thank you.